Hi, good morning, everyone. Thanks for joining us for today's conference call. We have kind of periodic conference calls to help share our views on the markets. Sometimes they're very topical, like DeFi. Today's a more zoom out 30,000 foot view of the crypto landscape. But we do want to help people understand what we think is going on and what I think is the biggest trade in a generation. So the agenda for today is, since most of you are new to Pantera, I wanted to give you a brief introduction to the firm, talk about our outlook for the markets themselves, some of the positions that we're investing in with my partner, Paul Radhatakit, and our principal, Chia, and then wrap it up with some brief overview of the funds themselves to the extent you have interest. First things first, this is really for you. It's to help share our views on the markets. Happy to answer any questions you have. So please feel free to use the Q&A box. Paul, Chi, and I will answer them, as we go. And any questions that are kind of generally of general interest, we'll save to the end and answer those live. So with that, I wanted to just give a quick background on the firm. I founded Pantera 20 years ago after I left being the head of trading at Tiger Management, working with Julian Robertson. I was also the CFO. And we launched the first cryptocurrency fund in the United States over 10 years ago. We now manage about 8 different fund products, about $4 billion in assets. It's split between long-term venture style funds and very liquid hedge funds. In the venture business, we've typically led most of the deals we've been investing in. I'll mention that briefly next. We have 4 offices, mainly San Francisco and New York. The fun part about this business is definitely a very global business. Since 2013, we've been investing all around the world. 40% of our investments are outside the United States, which is almost the same as our investor base. About 50% of our investors are from outside the United States. I do think it's the biggest trade in a generation. It's, in my opinion, essentially the second half of the internet. The internet was protocols to move all kinds of other types of data around. But even in the 90s, Milton Friedman said the only thing missing from the internet is the e-cash system. That's what Bitcoin is and all the subsequent blockchain protocols that we're using. And really the spirit of today's call is really to talk about, this is actually probably a great time to be investing in blockchain, which I know sounds a bit crazy because blockchain's down a ton. It's not really in the newspaper as much as it used to be. It's not on TV all the time like it was at the highs. But we are very cycle agnostic as investors. We're trying to be investing in good companies as we see them. And as you can imagine, genius comes at kind of a constant rate. It doesn't really, flow with the price of Bitcoin as a proxy for our industry. And so over the 10 years we've been investing kind of at a fairly consistent rate, even though the price of Bitcoin has skyrocketed and crashed 3 huge times in our cycle. This is our 3rd crypto winter that we've, I think, just come through. Maybe we're still in it, who knows? But the important point is there's fantastic investments to be made throughout the cycle. And then at the end, I'll come back and make some arguments on why, now is probably a better time than many times in the past to get exposure to this space. One of our colleagues, Jeff Lewis, gave a really cool analog to the dot-com bubble. And I really like it. I was at Tiger Management during the dot-com bubble, and it has a lot of similarities to this. Obviously, the other protocols that we now call the internet, we're going to completely change the world. They really revolutionized a lot of things like commerce and communication. As I mentioned earlier, they didn't touch finance and banking. That's what blockchain will do. But the important point is, even in that era, there was a ton of hype. And so all kinds of business models were tried. A lot of things were experimented with. A lot of money was raised in things that ultimately didn't work. And so that kind of gives a bad tinge to the topic of the dot-com bubble. But the important point is it's very similar to what we have here. These new protocols, which are kind of the second half of the internet, are going to revolutionize how we send value to each other, how businesses interact with their customers, and then very importantly, how to get centralized rent seekers out of the value chain. And so the whole concept of Web3 is removing these data monopolists that have been controlling the web for the last 2 decades and make it everything peer-to-peer. And because that is so fantastically important, it does encourage a lot of excessive hype, and it allowed a bubble to form last year. This analog, I think, is very well to look back at what happened in the years after the dot-com bubble burst, and that's essentially the best time to have invested. Some of the best companies were invented after the dot-com bubble. So, here's just a sampling of some of the most famous internet companies. Didn't even exist when everyone was all hyped about the internet. And I think you're going to see that here, that many of the most important projects, when we look back a decade or two from now, will have been formed, after the peak we hit a year and a half ago. So with that, I wanted to give just a quick synopsis of some of the occurrences in the market over the last 12 months. It's been, a pretty crazy time. And I did want to conclude with a thought on the venture investing from the dot-com era. Is 2003-04 was the best time to invest, even though, at the time it seemed horrible and everybody was super pessimistic. In hindsight, the IRRs are the highest for people who put money to work after the crash of that bubble. Okay, so in the current outlook, although there's a bit of negativity about blockchain, its resilience in the face of some absolutely crazy things in our own industry, and also terrible macro environment, I really think is impressive. And it's kind of a glass half full perspective or way to look at it. But although the industry's gone through some hard times, and the prices certainly are lower than they were 18 months ago, really is actually pretty impressive how well the industry has worked. So on the next slide, we have just a recap of all the challenges that you're very aware of. Some of them were in our space. So there were a bunch of centralized entities that took on, excessive leverage, very, in hindsight, poor risk management, and were made bankrupt. And then we also have obviously the special case of FTX, which allegedly committed a crime against 5 million people. So that's super crazy stuff, but super important note, it's all just old-fashioned leverage. It's just like the old banking crises. Blockchain itself functioned perfectly. We'll talk about it in a bit. DeFi functioned perfectly. So everything about blockchain was fine, but just, frankly, too much hype, very, very old school fear and greed, type of a problem. The banking crisis itself, though, is absolutely fascinating. We've had banking crises for 500 years. We had a banking crisis in 2008 that caused Satoshi to get so pissed that Satoshi created a movement that brought in 400 million people. But these crises are pretty similar to the old school ones. Excessive risk, too much duration, way too much uninsured deposits. All of those issues. Obviously, the speed at which SVB went under is breathtaking. The biggest bank failure prior to that was Washington Mutual. And in the worst week of their banking run, they had 17 billion deposits run out of the bank. Remember, in the old days, you had to actually physically go down to your bank. You had to stand in a line. You had to hear from a friend that the bank was struggling via like a telephone. With social media, it's just breathtaking how fast a panic can occur. And they had 45 billion go out in one day. So that leaves us with kind of a new concept that we're going to write in our June investor letter, about how banks might be suboptimal relative to stable coins, but we'll get to that next month. So the punchline of that is it really does prove the need for trustless systems. This is what we've been talking about for a decade, is we believe that blockchain is the next and much better evolution of interaction between humans to do commerce, communication, value transfer, all those things. In the old days, it was pretty tribal, essentially. It was people you actually knew personally, and that was how value was exchanged. And then for the last couple of millennia, we've been using institutions in between us, stock exchanges, banks, things like that. And hey, they've been great for a while, but they're expensive, and certainly we've just seen in the banking crisis flawed. Code doesn't eat very much, so it's much more efficient than humans, and code works great. And so that's the topic of the next slide. The story over the last 12 months has kind of been, oh, blockchain failed, DeFi failed, it didn't work. Frankly, the truth really is 180 degrees the opposite of that. DeFi worked great. All the things that blew up last year were centralized financial institutions, hedge funds, banks, although they may not have been called banks or registered as banks, they operated just like a bank does. And the really cool, irony of the whole crisis last year is DeFi protocols worked perfectly. They worked 24/7, executed all the transactions that people had committed to do, including forcing the failed, bankrupt, centralized entities to execute on their promises. So you essentially can't ghost DeFi, whereas you can ghost normal clients if you're a centralized entity. And so it really does prove the promise that Satoshi laid out. And in the next slide, we have actually a graphic. This is what the first Bitcoin block actually looks like. Embedded, in the first Genesis block is a quote from the Times of London, where Satoshi is essentially complaining about the Chancellor of the Exchequer is doing another bailout of a bank for 50 billion pounds. And I got to say, that's very nostalgic for those old quaint times when Satoshi could get so pissed at 50 billion. They're throwing trillions around these days, and nobody, seems to be counting. And so I think when we look back, we're going to see this era of both the policy response to SARS-2 and the impact of SVB and First Republic as being seminal in the acceptance of Bitcoin. And I don't think it's a coincidence that the so-called Bitcoin dominance, the percentage of the entire market cap that is Bitcoin, gapped up tremendously right after the SVB weekend. So on the next slide, so one of our last little bits on the market as a whole before I hand it to my partner Paul to talk about some of the deals we're doing, is one of the virtues that we have always thought was important about blockchain is it's a brand new $1 trillion asset class that historically has no correlation with anything else. And as you can see in this graph here, the 12-year price history of Bitcoin as a proxy for our industry has a very low, essentially zero correlation with S&P as a proxy for risk assets. That is a great attribute if you can find something that has an incredible 150% annualized return, and then a 0 or 0.1 correlation with the S&P 500. It's fantastic. Last year, it became highly correlated, as you all know. And I'll admit that was surprising. I didn't anticipate it. It did go up to 0.76 at one point, essentially right at the implosion of Terra Luna. And so you had these kind of crazy exogenous shocks coming in that, like FTX or Terra Luna or whatever, that caused a very high correlation with the S&P for a very brief period of time. Thankfully, the correlation is reverting to what I would consider the correct level. And right now it's at 0.2, which is extremely low. Most assets are 0.4, 0.5 to the S&P 500. And that's allowed blockchain to kind of revert to its own, I think, multi-decade secular bull market and not get caught up in the interest rate related sectors. Just a quick aside on the macro, having been a macro trader for 35 years, I really think there's some issues in the macro markets, and the Fed has to keep raising, and certainly not cutting to 3.25 as implied in the Fed funds futures market. That's making it very difficult for the traditional asset classes to rally. Obviously, bonds are mathematically linked to interest rates, and then the S&P is discounted cash flows, and the PE upside down is the earnings yield. So all those things are very correlated to rates. what we're hoping to see over the next several years is for blockchain to decouple. And luckily in 2023, we've already seen that. Bitcoin is up a ton. Ethereum up big, and the Bloomberg index up as well. So the last couple slides are just about the actual returns of Bitcoin. And one of the topics that we've talked about, and I'll mention briefly, is every 4 years, the number of Bitcoins that are issued is cut in half. It's called the halving. That has created a very pronounced 4-year cycle. And when I was in college, Burton Malkiel's Random Walk Down Wall Street was all about how, like, if we all know something, it can't happen. But Warren Buffett had a great line. He said the difference between always efficient and often efficient is worth 80 billion to him. And so although theoretically it shouldn't actually matter, since we all know it's going to happen, it really does have a huge impact on the markets. And so if you use this 4-year period as kind of the normal kind of periodicity or a rhythm of the Bitcoin market, and have a kind of venture style view of the investment and hold things for 4 years. Nobody that's ever held Bitcoin for 4 years has lost money. And it is typically been up, 400, 500, 600%, and in many periods, over 10x. And so the last slide I'm going to talk about is the year-over-year returns. I think they're actually kind of interesting in that it's now been about a year since Terra Luna blew up. And so having traded a lot of cycles over 35 years, there really is some amount of time beyond which humans just can't tolerate pain anymore. And so there really is an amount of time that the market can be down, and then it has to kind of start rallying again. And so in this case, Bitcoin is a proxy for industry, got killed when everything else got crunched. And we've had 7 bull and bear cycles in the 12 years that Bitcoin's been trading. And on average, the bear markets were down 73%. This last one was down 77%. I would think that as our market gets more institutionalized, the amplitude of those things would be going lower and lower. So I think that was plenty. And then the average length of a bear market is 264 days. This one was 376. So I really think having a full year of a bear market is plenty. And so we're about ready to get going. If the price of Bitcoin held flat, the year over year would go positive on June 12th, because we're now a year past all the craziness of the Terra Luna era. And so with that, I want to hand it to my longtime partner, Paul Verratacakis, to talk a bit more about the deals we're doing right now.
Thanks, Dan. So I'm Paul, and I'm going to chat a little bit about, Dan did a great job talking about sort of what's going on in terms of the past and global macro. I'm going to talk a little bit about the fundamentals of the industry, and then I'll talk about some of the areas of interest, and then a couple of case studies. I think what you'll get out of these slides is really that there's a lot of momentum going on in the industry. Obviously, with valuations, it's a great time to invest, and DeFi continues to remain strong. So if you take a look at this slide, you could see the monthly active developers. We've gotten this from some great sources like the Alchemy Developer Report. As you know, price can go up and go down and be volatile, especially within the last year, but the number of monthly active developers continues to increase. That's definitely one of our North Star KPIs. We want to make sure that there's more talent and more developers coming into this space. And you can sort of see that on the next chart around unique smart contracts on Ethereum. If you consider Ethereum, which has consolidated a bit on market share in terms of development, as the proxy for what's going on in terms of smart contract development, then you could see that the unique smart contracts on Ethereum has continued to increase now to 31 million. And I'd say the other thing that's interesting is, when we started in 2017 with our early stage token fund, we were hoping to invest into new protocols that were building on top of layer ones like Ethereum. And you could see on the bottom right that the market share outside of Ethereum in applications has increased and now is at 53%. I think that's important because it is correlating with the increase in the number of monthly active developers, that these developers are actually creating value that is eating into the overall market share of the entire crypto economy. And that's going to be important because you need applications to be able to really, bring, tangible use cases into the industry. And we'll talk about some of those tangible use cases. But one of the things that is another metric that, we sort of track in terms of DeFi and smart contract development is actually what's going on in terms of decentralized exchanges. So imagine all of these tokens, whether they are shares in the company or whether they are even tokenized real world assets. As they become tokenized, they need to be able to be freely traded. And so if they're able to be traded without centralized intermediaries, then you have a decentralized exchange, and decentralized exchange volumes has continued to sort of maintain, especially in this volatile market. Right now, it's sitting at about 110 billion. Underlying all of these applications are infrastructure layer protocols that are helping to scale smart contracts and transactions. So imagine, when we started the internet and being on sort of DSL 56K modem, it's hard for us to imagine, some of these really cool applications like eBay or even Facebook because the internet just wasn't fast enough. Now, after a few years, we've been able to have scalability both on Ethereum and also other layer ones. So you can see that right now, Ethereum is about $4 for a transaction fee, but there's layer twos that we'll get into a little bit later, Arbitrum, Optimism, and Polygon, that are basically on top of Ethereum and helping to scale Ethereum and bring transaction fees under $1. And there's even new layer ones. They're sort of categorized as high transaction throughput layer ones, like Mistin, like Aptos, that are bringing transaction fees lower than a penny. So, I think for blockchain to really sort of scale, we really do need to have more scalability so that applications like gaming or maybe even microtransactions for content can be enabled. So I'm going to quickly go through a few areas of focus that are really exciting for us right now. We've talked a lot about decentralized finance. Of course, outside of decentralized exchanges, there's decentralized lending and borrowing. One of the really big trends right now is actually institutions being given access to decentralized finance. One way is really through a company called Ondo Finance. They are allowing treasury yields to be tokenized. And now institutions and investors can get access to tokenized treasury yields. And then, of course, there's the interoperability within decentralized finance to actually put those tokenized treasury yields as collateral and take out loans on behalf of those. So I think there's a lot of potential to really sort of enable more and more sort of DeFi use cases through further tokenization and bringing global access to certain things that didn't have access before. Some other areas around consumer include, music and also freelance marketplace, but we're really excited about something like decentralized social. So imagine being able to have a decentralized Twitter where all of the content is immutable on a blockchain, and you can really sort of enable creators to further monetize by being able to enable them to, get rewarded for, issuing NFTs for engagement, or maybe even things around incentivizing users to earn rewards and tokens for, helping to curate a social network. So those are some of the areas that are interesting on the consumer side of things. On blockchain infrastructure, we've invested into both layer ones and layer twos, but I think one of the most popular infrastructure right now is probably around staking. And, so to be able to allow folks to get yield through helping to provide staking and validation of, for instance, Ethereum, as it recently went into proof of stake, has been, quite enticing. NFT, gaming, and metaverse, we still believe that NFTs are going to be a big part of crypto. They've kind of moved from PFPs or sort of profile pics over to items within games, and even NFTs to allow access to, different perks, such as, if you own an NFT that is tied to, Taylor Swift, you might be able to get layers and layers of access and rewards. And then, of course, the last category is picks and shovels. We led the Series A in Alchemy, which is a leading developer platform for cryptocurrencies. And we believe that there's going to be more and more developer tools, whether they are making it easier for you to facilitate cross-border payments like Circle, or maybe even develop applications cross-chain. So not only on Ethereum, but easily able to move assets across many layer ones. I'm going to go into two investments that we've done, Arbitrum. So we led the seed round of Arbitrum, and they recently went public with their token. Arbitrum is a layer 2 scaling technology for Ethereum using something called optimistic rollups. And they now are maintaining about 67% of all of the rollups that are on Ethereum. They have gone out to market and have done fairly well in decentralized finance. They have decentralized derivatives. They have other sort of DeFi projects that are gaining quite a bit of momentum, and then moving over into the gaming side of things as they continue to scale, lowering down transaction fees, and it should be very promising to really help Ethereum scale and bring more and more different types of applications on top. The team was funded by a few PhDs out of Princeton. We've been really helpful with them in terms of business development, strategy, tokenomics, and really, helping them think about what it takes to really create an ecosystem that developers want to build on top of. So far, there's 6 billion locked up within this protocol, and they've done quite a bit around gas savings. And the last project that I'll talk about is Sega. So as we think about more institutions wanting to get into crypto, probably going to get in through options, derivatives, and structured products. So Sega launched on Solana and was the #1 options protocol on Solana, started by a team of entrepreneurs coming from strong, large tech companies like Apple and large institutions like UBS. They were leading the TVL, or total value locked up, in Solana, and they have recently moved over to Ethereum. And they really allow you to get exposure to cryptocurrency and hedging some of the downside risk. And so we think this type of structure will be more and more enticing for institutions to dabble into crypto. I think for them, they're going to continue to gain more market share through making it very, very easy for these institutions to get in, either through sort of easier on-ramps and potentially even more products like indexes and things like that. So we're really excited about what they've done. We were co-leads in the seed round, and we continue to participate in the Series A. So I'm going to send it over to Chia to talk more about real-world assets.
Thanks, Paul. Nice to meet everyone. We have been super excited to have made a recent Series A investment into M0. M0 is essentially stablecoin infrastructure for institutions, and designed specifically to allow us to scale the utilization of stablecoins globally. The central thesis that we had behind this investment is that we have historically seen a large number of incumbents in the space really grow very quickly due to the market, but may represent some of institutional weakness as they try to mature. And the stablecoin space, especially in the decentralized side, represented one that we saw an opportunity to really double down on. I'm sure, as many of the folks listening to this call are aware, stablecoins represent one of the largest businesses that have product market fit globally and have a huge amount of demand from a wide number of users from all across the world, as well as institutions for a variety of use cases. The central thesis behind M0 then was that the ability to issue and utilize stablecoins at scale required the participation of decentralized stablecoins, of which some of the incumbents, again, were suffering from scalability and governance issues as they continue to mature. And so we found very experienced, traditional, as well as crypto native founders who had been exploring and trying to build in that space, and were able to successfully back them in achieving a decentralized stablecoin infra that is really purpose-built for institutional level governance. And we think that the timing for these types of businesses is very apt. As I think Dan mentioned in the very beginning, we have seen a change in macro, and that has represented a change in the types of businesses and financial products that would be interesting on chain. And we have spent a lot of time in the real world asset space. I think Paul mentioned Ondo as an example of some of the treasury infra that is increasingly being brought on chain, and M0 is one of these infrastructure providers to help really bring compliant stablecoins into the world, into various jurisdictions in a very compliant manner. And that's something that we've been really excited to back alongside folks like Standard Crypto, Vote Capital, Atri, etc.
Chia, thanks so much. So I want to wrap up with an overview of our funds and then obviously open it up for any questions that you have. So on the next slide, we have a quick kind of schematic of the different ways you can invest. It really is fascinating. It's the first time in history that you can own a piece of the protocols. I said earlier that blockchain is essentially the second half of the internet, but all the prior protocols like TCP, IP, SMTP, you can't own a chunk of them. Here you can actually own a chunk of the protocol, and those are called tokens. And so you can do venture investing, which is the way people had to get exposure to the rest of the internet. We've done about 2 billion of that over the years. And in many cases, that's, completely straight up, and just like, other venture investing, it just happens to be entrepreneurs doing something better, faster, and cheaper in a blockchain distributed ledger technology type business. And then you can invest in pieces of the protocols themselves. If you think about it, Bitcoin has 21 million units. Sometimes people call them cryptocurrencies, but another way to think about it's like shares in the Bitcoin protocol ecosystem. And so if you want to get exposure, you can buy a chunk of the ecosystem by buying some of those 21 million shares. So we have two hedge funds that are themselves covering the entire spectrum of tokens. One of them invests in tokens prior to them going public, our early stage token fund that invests in projects, prior to them being able to go live. We also invest in tokens once they become public. So in the equity analog, that'd be like public listed equities. And we have two funds there. We have one called the Liquid Token Fund that invests in a broad range of tokens. It is set up it's an evergreen fund. It's been around for 7 years. We hope it'll be around for another, 50 years. And so it's set up as a long short hedge fund. And I'll go over the details in 1 second. And then we also have the oldest fund in the United States, Pantera Bitcoin Fund, which allows institutions to get exposure to Bitcoin, which sounds trivial, but it's still necessary because things like GBTC are a very poor way to get exposure to Bitcoin. On the next slide, we actually have the last slide and the details of the funds. We've done 4 venture funds over the last decade. In 2024, we'll be raising our next fund. That'll be substantially similar to our prior fund, investing in venture equity, early stage tokens, and liquid tokens together. And so it's essentially an all-in-one wrapper for the entire ecosystem of blockchain. It's a long-only fund, and then we typically hold things for years, and it's available to anybody globally. All of our funds are set up such that we can take both U.S. investors and non-U.S. investors. And then we're actively always open on our passive and hedge products. The early stage token fund is investing long only in things that we typically hold for 1 to say 3 years. And that fund is taking in subscriptions monthly, and you can come out quarterly, subject to 12 months notice. And we do that essentially to protect you and other LPs from any kind of unregistered security issues that may ultimately be retroactively applied to cryptocurrency tokens. And then the liquid token fund as well, monthly inflows and quarterly outflows, only 65 days notice because everything in the fund, is very, very liquid. And so we want to pass on that liquidity to our investors. And lastly, on the Bitcoin fund, it's literally daily in and daily out with no lockup. So you can come in today on Tuesday and come out tomorrow on Wednesday if you really wanted to. We encourage people to hold it, for very long periods of time because we think of blockchain as venture style. And like I said earlier, if you hold it for 4 years, historically, at least, you've always made money. And so although we offer the liquidity that Bitcoin has, we want to, really make sure that people hold on to things for as long as possible. And it looks like my partners have answered most of the questions as we went. There is a question from Luke Gouldon on the early stage fund being the best way to get exposure to early stage tokens. It really is, because there is exposure to early stage tokens in the Fund 5 that we're going to be raising next year, but it's blended in with exposure to liquid tokens and venture equity. And if you really only want exposure to early stage tokens, doing it through the hedge fund is better, both because it's purely what you're looking exposure to, and then frankly, it's more liquid. You can come out quarterly with 1 year's notice. So it's essentially, if that's what you're trying to get, it's a much better way to do it. And then another question from Curtis Lowell on what's the difference between investing in the Bitcoin fund versus simply buying Bitcoin. Obviously, 10 years ago, when we launched the fund, it was way more complicated to buy Bitcoin, and there really weren't any ways for most institutions to get exposure. So it was really, at one point, the only way to get exposure, and then it was a good way. The question I often get is, well, why can't you just, invest in an ETF? The ETF's, potentially similar to this. It exists. Our fund does exist and has existed. Unfortunately, SEC still, after 10 years, which is really kind of mind-boggling, has yet to approve an ETF in the Bitcoin space. So an ETF on the spot market, there's a kind of weird one on the futures market, which has a lot of negatives to it. But there isn't one in the normal market for the for Bitcoin. So that's the advantage. And then the advantage on essentially just opening a Coinbase account or Bitstamp account and buying Bitcoin. We do it in massive size, and so we have extremely low fees on our purchases. And then, we have 24-hour trading, automatic trading, and so we typically get very good pricing. And actually, in fact, investors come in and out at the 24-hour value-weighted average price for the day. So you're essentially guaranteed to come in at the price that was kind of essentially mid-market for that day and come out at that price. So you don't have any price risk relative to doing it yourself. And then, not sure if you're asking on a personal capacity or for an institution, we have a lot of big endowments that are investors in Pantera Bitcoin Fund because, they just can't put a bunch of Bitcoins on a hard drive and put it in somebody's drawer, at their endowment. And so one of the advantages of Pantera Bitcoin Fund is it's, just straight up hedge fund, just like everything else in their portfolio. We got Ernst & Young do the first audit of any crypto thing in the world on that fund. And so it's audited. It's, we're SEC registrant. So, it's kind of got all the stuff an institution would normally want. And so it still is popular because it is better than, just buying some Bitcoins and putting them on a flash drive, which is not possible for institutional investors. Hey, with that, I have answered, all the questions you've all had. If you come up with any more questions afterwards, we really love the engagement. So shoot an email to ir@panteracapital.com, and then they'll route it to me or Paul or Chia or one of our colleagues and get you back answers. But thanks so much for participating. It's fun spreading the word because, I have enormous conviction that this is, the best trade of a generation. So it's good to have more people get involved. Thanks so much.